Welcome to the deep dive. We're here to cut through the noise and really focus on the essential insights. Today, we're plunging into, well, a pretty complex corner of finance: options contract and derivatives. Our mission: to take our sources, pull out the most important nuggets, and basically give you a shortcut to being properly informed. We want to unpack what options actually are, how they work, and crucially, why they've become such a huge part of modern finance. And I mean huge. The numbers are kind of staggering. Options trading volume up 150% in the last decade alone. And if you look back further, it's something like a 15-fold increase since 2000. It's incredible. Plus, you had that explosion in retail interest during the pandemic, hitting nearly 50% of volume. And it hasn't really dropped off massively since then, still hanging around the low 40s most months. So the big question is, why? What's driving all this growth?
Yeah, it's a great question. And it really points to a big shift in how people are trading. Options can seem pretty complicated on the surface, no doubt. But once you get your head around the basic mechanics, you start to see why they're so powerful and why everyone from pros to, everyday investors are using them.
Okay, let's unpack this then. Let's start right at the foundation. What exactly is an options contract?
Right. So fundamentally, an options contract is a type of financial agreement. It gives the person who buys it the right, and this is the crucial part, but not the obligation, to either buy or sell an asset. That asset is called the underlying security. Could be a stock, could be currencies, indexes, ETFs, lots of things. And this right is tied to a specific price, the strike price. And it only lasts for a certain time until the expiration date.
Okay, that phrase, the right but not the obligation, that feels really important. What does that actually mean for the buyer versus, say, the seller?
It means they have control without commitment, essentially. Think of it like a reservation. For having this right, this flexibility, the buyer pays something called a premium to the person selling the option. The seller is often called the writer. And typically, for stocks anyway, one standard contract covers 100 shares of the underlying stock. Historically, this kind of tool emerged because markets got more complex, more volatile. People needed a way to guard against uncertainty or maybe capitalize on unexpected price moves.
That flexibility seems key then to why they've, well, exploded in popularity. You mentioned those stats, that 15-fold jump since 2000, the retail surge.
Absolutely. It marks a real shift. Options went from being this sort of niche tool for professionals to something much more mainstream. And that's down to their core features: the ability to leverage gains, manage risk in sophisticated ways, and just offer strategic flexibility you don't get just buying and selling stocks.
Strategic flexibility. So what are the main things people are actually doing with options? What are the core goals?
You can really boil it down to three main uses. First, hedging, that's protecting your existing investments. Second, speculation, making bets, often leveraged bets, on where you think a price is going. And third, generating income, usually by selling options and collecting those premiums we mentioned.
Hedging, speculation, income. Okay.
And I guess the mechanics of how you do that depend on the type of option.
Exactly. There are two main types you need to know: call options and put options. A call option gives the holder the right to buy the underlying asset at that strike price. So you typically buy a call if you think the price of the asset's going to go up. It's a bet on appreciation, often with leverage. Then you have put options. These give the holder the right to sell the underlying asset at the strike price. You'd buy a put if you expect the price to go down. It's a way to potentially profit from a price decline.
Okay, calls for up, puts for down. But what about the seller, the writer? If the buyer has the right, not the obligation, what's the seller's position if the buyer decides to, exercise that right? Good question. The seller's position is the mirror image. They have the obligation. If you sold a call option and the buyer exercises it, you must sell them the shares at the agreed strike price, even the market price is much higher. If you sold a put option and the buyer exercises, you must buy the shares from them at the strike price, even if the market price is lower. So selling options comes with that obligation, which means a different, potentially larger risk profile compared to buying.
Got it. Obligation for the seller, right, for the buyer.
And just quickly, there's also a difference sometimes between American options, which you can exercise any time before they expire, and European options, which you can only exercise right on the expiration date itself. But the core concepts are the same.
Okay, so let's dig into those uses. First up, hedging. How does that work in practice? You said it's like insurance?
Yeah, that's a good analogy. Options can be really effective for hedging. They let investors protect their investments from potential losses, but importantly, without necessarily giving up all the potential upside if things go well. Imagine a portfolio manager. They hold a lot of different stocks, maybe across the whole market. They might get worried about a potential downturn, maybe over the next few months, but they don't want to just sell everything. So what they could do is buy put options, maybe on an index that tracks the market or on some of their specific large holdings. If the market does fall, the value of their stocks will go down, sure. But the value of those put options they bought will likely go up, potentially offsetting a good chunk of the portfolio losses. It cushions the blow.
Right. So it limits the damage.
Yeah.
Why would that be useful for, someone listening who maybe just has a regular investment account they want to protect? Is it practical?
It can be, but there's a cost. Remember that premium. You have to pay for that protection. So it's a trade-off. You pay the premium for the put option. If the market goes up, your stocks gain value, but you've lost the money you spent on the premium. It acted like insurance you didn't end up needing. If the market goes down, the insurance pays off by offsetting losses, but you still paid for it. So deciding if it's worth it depends on how worried you are, how much protection costs, and your own tolerance for risk. It's not free insurance.
Okay, that cost-benefit analysis is key. Now, let's switch gears to maybe the more exciting aspect for some people, speculation and leverage. You said options are widely used for this because of inherent leverage. How does that actually work, controlling a lot of stock value with a small premium payment?
This is where options get really powerful and also really risky. Let's use that ABC stock example. Say ABC stock is trading at $100 a share, and you think this stock is going to pop soon, maybe in the next month.
Okay, $100 stock expecting a rise.
Scenario one, you buy the stock directly. Let's say you want 100 shares. That costs you $10,000, right?
Yeah.
100 times $100.
Right, $10,000 investment.
Now, if you're right, and ABC jumps to $120 a share within that month, your 100 shares are worth $12,000. You made a $2,000 profit, a 20% return on your $10. Not bad.
Okay, straightforward.
Scenario two, options. Instead of buying the stock, you buy one call option contract on ABC. Let's say it has a strike price of $100 and expires in 1 month. And the premium, the cost, is maybe $2 per share.
Okay, so one contract covers 100 shares. That means the option costs $200.
Exactly, just $200 total cost. Now, if the stock still jumps to $120, that call option, giving you the right to buy at $100, is now clearly valuable. It's in the money. Its price might jump to, say, $20 per share. Remember, it reflects the difference between the stock price and the strike price, plus some other factors. So your $200 option contract is now worth $2,000. 100 shares x $20.
Oh, wow.
Your profit is $2,000 minus the $200 premium you paid. So $1,800 profit.
That's almost the same profit as buying the stock, but on only a $200 investment instead of $10,000.
Precisely. That's the leverage right there. Much smaller initial outlay for a similar dollar profit. Your percentage return is way higher. But here's the real kicker, the aha moment for speculators. What if you had taken that same $10,000 you were thinking of spending on shares and instead used it all to buy those $200 call option contracts? How many contracts is that?
$10,000 divided by $200, that's 50 contracts.
Right, 50 contracts. Now, if the stock hits $120 and each contract is worth $2,000?
50 times $2,000, that's $100,000.
Exactly. Your 50 contracts are worth $100,000. You spend $10,000 to buy them.
So the profit is $90,000 on a $10,000 bet.
That's the power of leverage in action. A massive potential return amplification.
So what does this all mean? That options are just a license to print money? It sounds too good to be true.
And that's where we need to pump the brakes immediately, because it absolutely can be too good to be true. Remember, options are what we call wasting financial instruments. That leverage cuts both ways dramatically.
Wasting instruments because they have that expiration date.
Exactly. They lose value over time. This is called time decay, or theta, if you want the Greek term. And if your prediction is wrong, or even if it's just not right enough or doesn't happen before expiration,
You lose the premium.
you could lose the entire premium paid. In that leverage example, if ABC stock stayed at $100 or went down by expiration,
Those 50 contracts.
worth zero, your $10,000 investment, gone. Poof.
Wow. Okay, so the potential for huge gains comes with the potential for total loss of investment.
Absolutely. The risks are significant. Trading options isn't just about guessing direction. It demands a really good understanding of market dynamics and those factors influencing the options price itself, like time decay, and also volatility.
Volatility, how does that play in?
Well, volatility is basically how much the market expects the stock price to move around. Higher expected volatility generally makes options more expensive, both calls and puts. So high volatility can increase your premium costs, making it harder to profit even if the stock moves your way a bit. And if volatility drops after you buy, The option price can fall even if the stock price doesn't change much.
So summarizing the risks then, for both quals and puts, the big shared one is losing your entire premium if the option expires worthless, out of the money.
Correct. That's risk number one.
And number two is that time decay, the value just eroding away as you get closer to expiration.
Yes, time is constantly working against the option buyer.
And third is volatility working against you, either by making options expensive to buy or by falling after you buy them.
Precisely. Those are key risks for buyers.
But what about the reward side? We saw the leverage for calls. What are the specific upsides for calls and puts, considering these risks?
Okay, so for call options, the big reward is that potential for amplified returns through leverage, like in our example. And a key benefit is that your maximum loss is known up front. It's just the premium you paid. You can't lose more than that when buying. Plus, they offer versatility for different strategies, not just pure speculation.
And for put options.
Puts offer the chance to profit if a stock price falls, which is harder to do otherwise without, say, short selling, which has its own complexities and potentially unlimited risk. They're also great for that hedging or portfolio protection we talked about. And just like calls, when you buy a put, your maximum loss is limited to the premium paid. You know your downside risk.
So managing these risks and rewards, it sounds like you need a clear plan.
Absolutely essential. You can't just buy an option and hope. You need to think about, are the market conditions right? Does the option's expiration date align with when I expect the price move? And crucially, what's my exit plan? When will I sell, either to take profit or cut losses? When might I exercise it, if ever? You need rules.
And I imagine there are countless strategies combining different options. We hear terms like covered calls or spreads.
Oh, yes. The strategies can get very complex, involving multiple option contracts, buying some, selling others, different strike prices, different expirations. Things like covered calls, which you mentioned, are often used for that third goal, income generation.
Right, income generation. How does selling options generate income? You mentioned covered calls.
So with a covered call, let's say you already own 100 shares of ABC stock. You could sell a call option against those shares. Someone pays you the premium. That premium is your income right away.
Okay, so you collect cash up front. What's the catch?
The catch is you've agreed to sell your shares at the strike price if the buyer exercises the option. So if the stock price shoots way up above that strike price, you miss out on those bigger gains because you'll likely have to sell your shares at the lower strike price. You cap your upside on the stock.
Ah, okay. So you trade potential big gains for definite income now.
Exactly. If the stock stays below the strike price, the option expires worthless. You keep the premium, and you still own your shares. So it can be a way to make some income from stocks you hold long term. There are other income strategies too, like selling cash-secured puts, where you collect premium for agreeing to potentially buy a stock at the strike price if it falls.
So selling options involves taking on that obligation we talked about earlier in exchange for premium income.
Precisely. It's a very different risk-reward profile than buying options. Sellers generally profit if the option expires worthless, while buyers need the underlying asset to move significantly.
Fascinating. Now, we focus heavily on options, but you mentioned they're just one type of derivative. What else is out there, briefly, and what's this idea of natural hedging?
Right? Options are part of a bigger family. You also have things like futures contracts, which are obligations, not rights, to buy or sell an asset at a future date and price. Very common in commodities and indexes. There are forwards, which are similar to futures but more customized and traded over the counter. And swaps, which involve exchanging cash flows based on interest rates, currencies, or other things. They all serve similar broad purposes: hedging, speculation, diversification, just with different mechanics and risk profiles. And natural hedging is different altogether. It's managing risk without using these derivative instruments. It's about structuring your actual business operations or your core portfolio holdings so that potential losses in one area are automatically offset by gains in another, like maybe a multinational company arranging its foreign currency debts and assets, so currency fluctuations naturally cancel each other out, reducing the need to buy currency options or forwards.
That makes sense, sort of building the hedge right into the business or portfolio structure itself. Okay, so wrapping this up, we've covered a lot of ground on options. We've learned they're contracts giving the right, not obligation, to buy calls or sell puts an asset at a set price by a deadline. We've seen they're used for hedging risk, speculating with leverage, and even generating income. The key seems to be understanding that flexibility, the premium cost, the time decay, and the leverage, both its power and its danger.
Absolutely. And maybe a final thought to leave you with. What's fascinating here is, given the inherent risks and that wasting nature of options, How does a deeper understanding of the specific factors affecting an option's premium like time decay and market volatility become just as critical, maybe even more critical sometimes, than just predicting where the stock price itself is going? It adds whole other dimensions to the strategy. It's not just what the stock will do, but when and how volatile the journey might be.
That's a great point. It's not just direction, but time and volatility too. Plenty to think about there. Thank you for joining us on this deep dive into the world of options and derivatives. We hope you feel a bit more informed, maybe a bit more curious. Until next time, keep exploring and keep learning.